Over the past few years, the economic relationship between the United States and China has been changing. For a long time, the US relied on China to produce many goods at low cost. American companies set up operations in China, and huge amounts of money flowed from the US into China's factories. China became known as the world's factory, making everything from electronics to textiles, and then shipping these products back to the United States. But now, that situation is shifting. More and more, the US is looking beyond China for production and trade. It is starting to invest more in places like Mexico, India, and Vietnam. Among these countries, Mexico seems to be getting the biggest benefit. Why is this happening? There are several reasons. First, during Donald Trump's presidency, the US government accused China of unfair trade practices, intellectual property theft, and causing a large trade deficit. In response, the Trump administration imposed tariffs on many Chinese goods. A tariff is like a tax on imports. By making Chinese products more expensive, the idea was to encourage American companies to buy less from China and maybe buy from other countries or produce more goods inside the US itself. While the results were mixed, one clear outcome was that American companies did start looking more closely at other places to manufacture their products. Mexico, with its proximity to the US, naturally became a strong candidate. Another reason behind this shift is the rising cost of labor and production in China. When China first became a global manufacturing hub, its labor costs were very low. This drew many foreign companies eager to take advantage of cheap labor. But over time, China's economy grew much stronger. Wages rose, and the general cost of doing business there increased. This meant that producing goods in China was no longer as cheap as it used to be. For instance, in 2012, the average annual wage in China was about 47,600 yuan. By 2023, this had more than doubled to around 121,000 yuan, or roughly $16,900. While this may still be low compared to some developed countries, it is much higher than it was before. As a result, many companies felt they needed to look for cheaper alternatives, or at least spread their risks by not relying on just one country. These changes have led many people to believe that the US is now reducing its dependence on China and is possibly investing less there. Many also think that the US is now relying more on Mexico. But to understand if this is really true, we need to look at the data on trade and investment. International trade is the exchange of goods and services between countries. When the US buys goods from China, that counts as imports for the US and exports for China. When the US sells goods to China, it counts as US exports and Chinese imports. If we look at who the US traded with in the past, we can see some interesting patterns. In 2010, the US Census Bureau showed that Canada was the United States' largest trading partner in terms of total trade. Total trade means imports plus exports. In that year, Canada and the US traded over $525 billion worth of goods, while the US and China traded about $456 billion. But if we break that down further, something important appears. The US imported more from China than it did from Canada. Although Canada was the top partner in total trade, China supplied a large share of goods that Americans bought. Those imports sent a lot of money into China's economy, helping it grow very quickly and become the manufacturing powerhouse we know today. By 2018, the story changed. China had become the United States' largest trading partner, with over $659 billion in total trade. This reflected how deeply intertwined the two economies had become. However, 2018 was also the same year the Trump administration's tariffs on Chinese goods kicked in. These tariffs made importing certain Chinese products more expensive, and American companies started looking for other sources, including Mexico. If we jump to 2023, the data shows that US trade with China declined from $659 billion in 2018 to about $429 billion in 2023. That is a big drop. During this time, Mexico's trade with the US has grown. In fact, Mexico is now a top trading partner, attracting some of the trade that once belonged to China. It seems that Mexico has taken over a good portion of the US market share that China used to have. This shift in trade can have big impacts on a country's economy. Why? Because exports, selling goods to other countries, help a nation's economy grow. Exports create jobs, boost local industries, and bring in foreign currency. Decades ago, China's surge in exports to the US helped transform its economy. Factories in China expanded, workers found employment, and new infrastructure like roads, ports, and trains were built. China's economy depended heavily on selling goods abroad during its major growth years. At one point, exports made up more than 30% of China's GDP, a huge share for such a large economy. This export-led growth allowed China to accumulate massive foreign exchange reserves, which reached about $3.3 trillion by 2023. These reserves help protect China's economy from global shocks and give it financial flexibility. Now, as the US turns more to Mexico, we can expect Mexico to benefit in a similar way, though probably not on the same scale as China's past growth. Mexico's exports have risen steadily, especially after 2020, reaching around $647 billion. As Mexico exports more, it earns more money, which can help strengthen its economy. Higher exports mean more factories, more jobs, and more infrastructure development. While Mexico does not have the giant trade surplus that China once enjoyed, this increase in US-Mexico trade still brings positive economic effects for Mexico. It can lead to a more stable economy, more investment, and perhaps a stronger position in the global marketplace. Another critical piece of the puzzle is foreign direct investment, FDI. When American companies invest abroad, they often build factories, offices, and supply chains in other countries. For a long time, the US invested heavily in China. In 1982, US direct investment in China was just $49 million. By 2023, it had skyrocketed to over $126 billion. This money helped build China's manufacturing base. Chinese firms, often working with American partners, learned advanced manufacturing techniques. This investment also fueled the flow of goods from China to the US. Even though relations between the US and China cooled in recent years, and the pace of investment slowed, it's clear the US remains heavily involved in China. On the other hand, the US has also long invested in Mexico. But recently, these investments have picked up speed. In 2020, US investment in Mexico was about $110 billion. By 2023, it had grown to over $144 billion. Why did this happen? Part of it has to do with the lingering effects of the tariffs on China, ongoing political tensions, and the desire of American companies to spread their supply chains across multiple countries. By 2023, US investment in Mexico even surpassed its investment in China. This doesn't mean the US abandoned China. It just means that American companies now see Mexico as an even more attractive place to invest, given its close location and strong trade ties with the US. One might ask, does this shift in investment and trade mean that American investors are fully leaving China for Mexico? Not exactly. China still offers many advantages, such as a huge domestic market and advanced manufacturing. Even if the US is not increasing its investments in China as fast as before, the existing investments are still substantial. Many American firms have well-established supply chains and partnerships in China that they will not give up easily. What we are seeing is a strategy of diversification. Instead of relying on China alone, US companies are spreading their bets. They are investing in Mexico, India, Vietnam, and other places to reduce the risks associated with focusing on one country. This diversification is not just happening on the US side. China, too, is adapting to these changes. One interesting trend is nearshoring. Nearshoring means placing production facilities closer to the main consumer market. In this case, the main market is the United States. By setting up factories in Mexico, foreign companies can reach US consumers more easily. They can avoid some of the tariff costs and reduce shipping times. And it's not just American or Mexican companies doing this. Chinese companies are also investing in Mexico. For example, a well-known Chinese company called BYD, which specializes in electric vehicles, decided to invest in Mexico. BYD has grown significantly in recent years, becoming a major player in the global electric car industry. Some reports even say BYD has outpaced Tesla in certain measures. By producing in Mexico, BYD can ship its products to the US more quickly and maybe at a lower cost than if it produced everything in China. This strategy helps BYD and other Chinese companies maintain their access to the giant US market. Even if US-China trade tensions remain, Chinese firms can still tap into American demand by working through neighboring countries like Mexico. In conclusion, the relationship between the US and China has shifted. The US is importing less from China than it did a few years ago and is importing more from Mexico. The US is also investing heavily in Mexico, and Mexico is benefiting from this situation. Meanwhile, US investments in China have not disappeared, but they are not growing as fast as before. China, for its part, is adapting by investing in places like Mexico to ensure it can still serve the US market indirectly.